Economic Kathy Wood. China's collapse is the worst economic disaster ever. Welcome to Cash Street, where cash is always king. Over the past 2 decades, China has developed into an economic powerhouse. No other nation in the world has experienced growth comparable to China's, but what if I told you that all of China's growth was a bubble? That's what Arkhanvest CEO Kathy Wood thinks when she compares China's expansion to Japan's 30-year economic disaster in the early 1990s. The same way that Japan's GDP was fueled by a real estate bubble, China is currently experiencing the largest housing bubble in history. In this video, I'll go over everything you need to know about China's impending demise. Throughout the course of recent years, China's economy has developed significantly, yet an extensive piece of that has come from the land. In order to expand their real estate portfolio to hundreds of cities, property developers have taken out loans. We're talking about contemporary homes, office buildings, and apartments made of glass and steel in Chinese cities. Speculators began purchasing houses solely for the purpose of increasing their value. After all, housing costs have been rising annually for decades from the perspective of Chinese citizens. This was partly due to China's rapid population growth, but the speculation went even further because housing projects continued to rise year after year. In major cities like Beijing and Shanghai, the majority of Chinese citizens were unable to afford a standard house or apartment. The logical thing to do would be to buy a house close to the cities but far enough away that it would be cheap, and many people did just that. Due to the growing demand for houses in close proximity to cities, people began flocking toward apartments and houses 10 to 15 miles away from Chinese cities. Prices started going up, which caused people to move even further away from the cities. Because real estate developers anticipated that this expansion would continue, they began building houses earlier and earlier. You'll notice something very strange if you drive outside of Beijing or Shanghai for a couple of hours these days. There are numerous modern buildings in excellent condition, but there is one problem. Nobody is present. Because only speculators believe that prices will rise, these cities are referred to as ghost cities. This demonstrates that China's expanding real estate bubble is a significant economic engine. Take a look at the new town of Ordo, China's most famous ghost town. The city was supposed to have 1 million inhabitants, but that number fell to 300,000 in 2016 and finally to 100,000. Ordo's new town was able to fill its empty houses only after top schools moved into the city. These vacant units are so prevalent that the total amount of space available could practically accommodate Italy's entire population. The value of the Chinese real estate market has increased by more than $50 trillion in the last 2 decades. 2 times more than in the United States and nearly 4 times more than the entire GDP of China. According to Loomis Sales, an investment management company, real estate accounts for 70% of China's total wealth. It is not unusual for people in China to save money for decades just to buy one home. Even after years of saving, citizens will be forced to rely on mortgages to afford to house because property prices are so high relative to income. This is made worse by the fact that citizens are afraid to miss out because of rising property prices, ultimately compel citizens to take out risky amounts of debt. China is home to 4 of the top 10 cities with the highest housing affordability. This kind of gratitude is troubling and won't last forever. This was evident in the American recession of 2008, and similar signs are currently emerging in China. Because prices in the Chinese housing market continue to rise at an exponential rate, the real estate boom in China is already beginning to show signs of a significant slowdown. Like before any financial crisis, property developers have done anything to expand their real estate portfolios as quickly as possible. Before the crisis, greed took over, and developers soon had too much debt to handle. Evergrande, the pinnacle of Chinese real estate development, was one of these developers. Evergrande grew its real estate portfolio to over 565 million square meters of development land through the use of corporate bonds issued to international investors. Evergrande is one of the largest real estate developers in the world. Evergrande's debt cancellation of over $300 billion made this possible. Evergrande flourished as a result of its extensive access to capital. Evergrande rose to the top of the real estate market in 2018 and became the world's most valuable company. However, investors soon began to notice that Evergrande was in serious financial trouble. Evergrande was recently placed in default by credit bureaus after the company failed to pay an interest payment of $260 million. The credit clamor because of this has been outrageous as Evergrande's bond costs have fallen altogether throughout the course of recent months. As a result of Evergrande's debt crisis, international bondholders are threatening to sue the company. President Xi Jinping's crackdown on the Chinese real estate industry is a factor on some of these disputes. By reducing real estate speculation, the presidency is attempting to lessen China's reliance on the property market. Xi's motto is that homes should be used for living, not speculation. The actions taken by the president pose a threat to China's economic stability. Although Evergrande is a significant development, it is just one of the many that have defaulted. Currently, Chinese real estate developers are dropping like flies. For instance, Chinese developer Shi Mao recently defaulted on an interest payment of $101 million. A recent stock exchange actually revealed that Oceanwide Holdings, an additional developer, had defaulted on a loan of $175 million. In the fourth quarter of 2021, a total of 484 businesses were behind on at least 3 commercial payments. That is a staggering sum, but the catastrophe is only getting worse over time. Property developers are well aware of the fact that Chinese real estate may not be the best market at the moment. In December 2021, contracted sales for the top 100 real estate development companies decreased by 35%. Kathy Wood claims that this is the first year in more than 2 decades that the development company has experienced a decline in sales. Presently, another thing I want to zero in on here is China. So a lot is happening in China that again, the titles are getting a portion of this. However, in the span of a multi-week, a Bloomberg columnist, Sofia Horta Acosta, revealed that all of these occurred in more noteworthy China this week. I will just peruse a couple of these to provide you with a feeling of the show here. Evergrande was ordered to demolish 39 illegal buildings because they lacked the necessary permits, and trading on the stock exchange was halted. Imagine if that were to occur in the United States. The biggest 100 biggest designers in China detailed that their contracted deals were down 35% in December, and for the year in general, they succumbed to the initial time. Shi Mao, which was rated investment grade in November, defaulted on a trusted product and rocked the credit market, and the central bank withdrew liquidity. A lot of people thought they were going to increase liquidity because they said they would. Sophia says in at least 5 years, I don't think I've ever seen them fall in the last 20 years. After the rocky start to the stock market, a Chinese regulator promised stability, but they haven't done anything about it yet. And very interestingly, the yuan. The RMB nearby money following an exceptionally impressive year held up, and I think it is presumably helped by the public authority. It is beginning to weaken, which is a telling sign. One stock called Harang, which hasn't traded since March, opened this week and dropped 50%. Indeed, even the central bank has observed China's lodging bubble as the Fed accepts that China's landlocked jam could at last damage the US economy. According to the Fed, problems in China's real estate industry could put pressure on the financial system and spread to the United States. The Fed cited China's government and local debt as a major concern to support this claim. China's rapid GDP growth is viewed as a sign of economic prosperity by many economists. In any case, a huge piece of that development was topped off by a humongous obligation bubble in the land as well as in China's whole economy. Over the past 2 decades, Chinese household debt has significantly increased in relation to GDP and income. Debt in households is rising faster than GDP. While China's GDP has increased at a phenomenal rate, the country's debt balance has increased even faster. China's total debt as a percentage of GDP is almost identical to that of developed nations as a result of the severity of the debt crisis. Imagine China's economic powerhouse having a debt-to-GDP ratio almost identical to that of developed nations. Such an excessive extension will undoubtedly have negative effects. A stretched real estate valuation and how the Chinese Communist Party's crackdowns could crash those valuations were also mentioned by the Fed. The 3 red lines policy that the Chinese government is enacting in the real estate sector was the subject of that statement. Real estate developers are limited in their borrowing capacity by 3 red lines: a liability to asset ratio of less than 70%, a net debt to equity ratio of less than 100, and cash with a short-term debt ratio of 1 are the 3 requirements. For each red line they comply with, businesses that meet these thresholds can increase their debt level by 5% per year. Although it is reasonable to implement such a policy, the government ought to have done so many years ago. Kathy Wood compares the CCP's action to playing with fire because their new policies have the potential to smolder the entire property industry. It will be challenging to bring the developers back to their feet now that they have become overworked. A minimum of 1 red line has been crossed by 2/3 of the top 30 Chinese developers. The problem with these 3 lines is that developers of real estate can't just cut their liabilities in half. The only way to meet the lines is to sell real estate, which is exactly what many developers are trying to do right now. Evergrande and Kaiser Group Holdings are attempting to quickly sell their properties. Evergrande wants to sell the tower that houses its Hong Kong headquarters, the Evergrande Tower. Kaiser Group Holdings has put 18 of its projects with a combined square footage of 4.7 million square feet on the market. But unlike Evergrande, Kaiser has not yet sold any of these projects. However, the property has not yet been sold. The issue with these properties going on special is that there aren't any purchasers accessible. This is due to the fact that every other real estate developer is attempting to fulfill the 3 red line requirements as well. Assuming there are no purchasers for all this property available, the main arrangement would be for Evergrande and Kaiser to bring down their costs, and when those costs are brought down again and again, the market will implode. This was demonstrated when Evergrande announced that, in an effort to raise funds, it would offer a 30% discount on all properties. A 30% drop is an enormous sum, however, even that isn't enough for purchasers to clear in. Evergrande does not have enough sales of its properties to cover the interest on its loan. China's previously rapid GDP growth, which economists have marveled at for decades, will be hurt by this. 29% of China's economic output comes from property development. Imagine what would happen to GDP if the industry collapsed, according to the Federal Reserve. The upcoming slowdown in China will not affect Chinese citizens, but it could affect people all over the world. According to the Feds, the slowdown in China's economy could put pressure on global financial markets by changing people's perceptions of risk, which could harm global growth and the United States. To put it another way, the entire world's economy would suffer if the Chinese real estate market collapsed because almost every product you can think of is manufactured in China. You might think that China is too big to fail, but this kind of economic slowdown has happened before, even though the crisis happened many decades ago. In 2019, over 28% of global manufacturing output came from China. The current real estate crash in China and Japan are very similar. Japan was the gold standard for expanding economies in the 1980s. Economists believe that Japan would eventually surpass the United States as the world's largest power. According to news reports, Japan's theoretical land value was 4 times higher than the total value of all U.S. lands. Other nations around the world aspired to Japan's rapid growth in real GDP, which averaged 3.89% per year in the 1980s. Japan was in a massive debt crisis after decades of flourishing economic growth. After the Ministry of Finance encouraged corporate borrowing, Japanese businesses, like those in China, took out huge loans. In addition, the Finance Ministry advocated for the deregulation of interest rates and domestic stimulation, both of which contributed to annual increases in the money supply of 8% to 10%. Japan's GDP grew at the same rate as prices, but despite its rapid rise, the country's economy eventually collapsed even faster. By 1992, the Japanese stock market had fallen by almost 60% to 15,900. In addition to the 60 losses that had already occurred, the Nikkei index experienced an additional 45% decline over the following 2 decades. Equity prices did not recover for decades, which is why this crash is referred to as the lost decades. Kathy Wood is of the opinion that China is in a situation that is very similar to this one. China's real estate prices have reached new highs, and this is due to a growing debt crisis. The consequences of China's impending crash are extremely deflationary, and more specifically, the struggling economy of China is going to crash commodities to unbelievable lows. Kathy is perplexed because commodities haven't crashed a lot yet, which could have significant repercussions. Although consumer confidence remains relatively high, it could be misled by food prices because of a decrease in consumer confidence. Now, when China gets a cold, commodities usually get pneumonia. We're seeing this in some commodities like iron ore prices, but it's not yet clear how this could be happening if the economy wasn't falling apart and consumers weren't getting restless. I asked our team this morning how this could be. Pork and rice prices are crucial, and what do we see happening there? Pork prices are down depending on the measure 33 to 50%, and rice prices are fairly flat, apparently keeping the consumer happy. However, what I learned this morning makes sense because one of our analysts, our newest genomics analyst Pierce, worked in his lab while he was completing his PhD at Texas A&M with other Chinese students. In fact, he only worked with Chinese students. As a result, pork prices and rice prices are critically important. Now, I'm not sure, but I think this property scandal is quite interesting. We'll see. Property costs are as of now crashing as I speak Chinese. Property deals fell by north of 16% year over year in November, and new home costs fell by 0.3 months over a month. Although a decrease of 0.3% month over month may not seem like much, when annualized, this equates to a decrease of 3.6%. The rate of decline in Chinese housing prices has not been seen since the economic slowdown in China in 2015. Cathie talked about why she thinks China's economy will slow down significantly in the next 3 to 6 months in the quarterly report from Arkhanvest. According to Cathie, the market is likely to focus more on the risk of a recession in the United States, a serious slowdown in the economies of China and emerging markets, and a possible unexpected drop in inflation if we are correct in the next 3 to 6 months. Iron prices have dropped 35%, possibly as a result of the turmoil in China's real estate market, while the Baltic Freight Dry Index has dropped more than 40%, with DRAM prices at 25 and US lumber prices at 33. Despite the WTI oil price, a notable outlier has decreased by 12% up until just recently. The Chinese Communist Party has taken steps to prevent a crash because it is aware that the economy is weakening. In an effort to boost the economy, the Central Bank of China recently announced that it would lower interest rates. This directly contradicts the desire of Federal Chair Jerome Powell to raise interest rates immediately. The property market in China is definitely in a very bad spot that is only going to get worse over time. Due to tightening credit and restrictive policies, the S&P rating agency anticipates a 10% decline in national residential sales in 2022. This decline will have an impact on you in some way, regardless of where you are viewing this video. Having said that, please comment below with your thoughts on China. Kathy Wood, do you agree with me? Please subscribe and like this video if you enjoyed it, and I'll see you in the next one. Thank you from Cash Street, where cash is always king.